What's going on, guys? It's Tim, and today I have a different type of video for you. We're not going to go into any individual stocks. We're just going to look at some macro stuff. We're going to look at interest rate hikes and what it's historically done. We're going to look at housing. We're going to look at consumer credit, and I'll just go into my thoughts and feelings of where I think the bottom's going to be when we start turning around finally. So if you like these videos, don't forget to like, subscribe, hit the notification bell. I know it's kind of different than my typical videos, but let's look at a couple things. And first off, just looking at TradingView's heat map, you see that we're having a pretty decent day in the market. And looking at the SPY, it looks like it's trying to break out of this channel, but it may be failing and we may be in for some lower levels. Keep an eye on this trend. You'll notice that we hit a short-term peak here in the middle of August, and it just so happens that that was a test of the 200-day moving average. It did fail, and upon failure, we just started absolutely dropping. I personally think this is an indicator that you're gonna wanna watch, and once we broke out of it in 2020, it literally ran without even touching that blue line for almost 2 years. So you're going to want to keep an eye on that 200 MA, and you're going to want to see it start curling to the upside. And for now, I do think we're going to likely test some new lower levels. Now let's look at credit card information, some home buyer stuff, and then we're going to get into when I think we're going to actually turn around. And I do think this is drastically going to affect the economy. I think we haven't fully seen it yet, but we do have some very bad signs starting, such as the fact that credit card balances hit nearly $900 billion in the second quarter. And I've got an interesting quote here from Barry Zingas. It basically says, "You can get behind the 8 ball if rates start rising and your wages don't." That's really the disconnect here. And this Barry Zingas, love the name by the way, he was actually senior vice president for community lending at Fannie Mae from 95 to 2006. And he also says, "I would caution consumers to always plan for the worst, hope for the best, but often in these circumstances, people find themselves planning and hoping for the best, which is not a good recipe for success." And, you know, these things are going to eventually crack the economy. You can't just have prices continuing to raise while people are making the same amount of money. Eventually, something has to crack. Eventually, see those house prices considerably dropping, and we've already been seeing that. I'm actually in the process of buying a home, and so far, prices have come down at least around 10%. You know, I do think we're in for some lower prices as the Fed continues to slowly raise rates. Now, it's obvious with our CPI that came out that it seems like they're really not getting control of it. So I don't think we're at the end of raising rates yet. I do think they're going to start chilling out a little bit because we are reaching near a breaking point where people just can't afford things. The credit keeps racking up, and it's going to get to a breaking point where people just simply can't afford anything. And I do think we're getting near that point, you know, a little more interest rate raises, and it's going to be near impossible for many folks to finance a house, if not at least considerably drop the total price that they can afford to pay. And just right here, rates for the standard 30-year fixed mortgage have doubled since the start of the year, meaning a monthly payment of a $400,000 mortgage now costs $865 more a month than it did in January. I mean, that is absolutely a massive difference, and if wages don't match that, it's gonna hit this point where the prices just have to come down to accommodate those raising rates, and we've already been seeing that. Now, like I said, I'm purchasing a home, working on purchasing a home, and I don't personally think it's the best time to be a buyer, but this is just the current situation I'm in. I personally think a great time to start buying a home would be probably in the next 3-6 months, even a year from now, but we're gonna have to see those prices continuing to drop, which we are starting to see. I think the downtrend has started, and that's the direction we're gonna be going as we continue to see rates rise. Now, can rates rise for another 6 months, even for a year? It's very possible. I think it's pretty unlikely that we're just going to see these aggressive rate hikes, and we are getting towards the end of it. In terms of 75 basis point rate hikes, even 50, I think we're going to soon get to where we're just doing 25 basis rate hikes or even getting to 0 and just seeing how inflation does. You know, the year over year numbers are going to get harder and harder to increase year over year because we're comparing against such high inflation numbers previously. So I do think we're going to hit this point where you start seeing inflation numbers just drastically fall off a cliff, and at that point the Fed will be able to lower rates, but by then the market will already be on a recovery, in my opinion. And I wanted to show you this chart here. This shows 2017, 18, and 19. You'll see that we had these rate hikes in 2017, but what was happening to the stock price? It was just rising up until this certain point here. Right before 2018, we had a pretty nice drop, and then in the end of 2018, we also had a drop. But what happened? Before we even had rates starting to get cut, we had a drastic increase in the SPX. So I think it's very interesting to see that we didn't see these rate cuts yet, and the market already was on a huge recovery. I personally see that being the same case again. People start speculating that the Fed is getting near an end of rate hikes, maybe even getting towards rate cuts, and the market will be on a recovery. Remember, the market is forwards looking. Does that mean we're just going to start running up from here? Absolutely not. In my opinion, we're in for some lower prices. We are in a downtrend in the market, And until proven otherwise, I think that's the direction we're going to go. But let's see why we were seeing the stock price go up while we were seeing rate hikes, because there's just a clear disconnect there, right? And what we were seeing during that time was actually 0.25% or 25 basis point rate hikes, which really is not at all what we're seeing now. And also, look at their target range. You're talking about under 2%. I mean, this is such low interest rates. I think that's why the market didn't really mind much. And also, these rate hikes were on the back of a good economy. The Fed saw that the economy is doing so good, so let's raise those rates. This is not about inflation during that time. It is a totally different environment at that time. So completely different catalysts, completely different reasons for the market to rally while we were seeing rate hikes. We were seeing a smaller rate hike, and it was on the back of a good economy. The economy was doing great. Inflation was fine. And I mean, look at the inflation forecast back then. You're talking about less than a 2% inflation. That is absolutely why. So just because the Fed is raising rates doesn't always mean the market is just going to go down. It also depends on the macro outlook. It depends on how the economy is doing at the time. It depends on where current inflation is at. It depends on where the wages are at, where jobs are at. There are definitely a lot of moving parts, but in my opinion, we will get to a point where those rate hikes start coming in lower and lower. While they are still going to be hiking rates, in my opinion, for this foreseeable future, the market will start anticipating a pivot, although we may still be quite a ways from that pivot. I still do think we're at the beginning of the housing market dropping. I think it's going to drop at least another 10% or so from here, if not even more. But you know, it really depends on how much more the Fed is going to continue to raise rates, because that just destroys purchasing power. If you're approved for 450,000 and the Fed keeps raising rates, eventually you'll only be approved for about 400,000, if not a little bit more. Because as your financing gets higher, as your interest rates get higher, the total sale price you'll be able to afford is going to be lower. Now you have to finance for a higher APR. But in the end, I'd rather buy a house at a discount with a little bit of a higher rate than to buy a house at the peak of the market with a low rate. You can always change your interest rates, but you can't change the price you bought that house at. Something to always consider. But how do you guys feel about the macro economy? What do you think about rate hikes? Are we going to see the Fed start changing their stance? Are they going to get a little less aggressive as we see the CPI start coming down? I do think we are going to see it start coming down at some point. But for now, the Fed is definitely worried that what they're doing isn't working out. But I think we will see that very soon. And at some point, the Fed will be trying to pick up all the pieces and keep that purchasing power from just absolutely deteriorating. At some point, people just simply can't afford higher and higher and higher rates. There will be a breaking point. Now, is that 3 months from now? Is that 6 months from now? It's anybody's guess, but I can guarantee that soon we will see those rate hikes decrease. But we are in for some more pain beforehand. But thanks as always, guys. Let me know how you feel about the overall market. Are you watching the SPY? What do we need to see to finally see the market turn around? Do you think it's just the Fed's stance? Do you think there are many other factors? And where does the economy go from here? Thanks as always, guys, and take it easy.